Historically, India's corporate tax rates were, frankly, among the highest globally.
Oh, absolutely. Way back in the 90s, you were looking at effective rates sometimes soaring to 50, maybe even 65%.
Wow. And even more recently, say between 2005 and 2018, they typically hovered around, what, 33 to 35%?
That's right. Which really highlights just how bold the Taxation Laws Amendment Act of 2019 truly was.
Yeah.
People were calling it, the boldest step to stimulate the economy since India's economic liberalization back in 1991.
A dramatic shift, no doubt. For most existing domestic companies, the base rate was slashed from 30% down to 22%.
Big drop.
And even when you factor in all the standard extras like surcharges and cesses, which are, extra taxes for specific programs.
Right, the effective rate.
Still meant a significant cut, down to around 25.17%. But it got even more aggressive for new manufacturing companies, didn't it?
It really did. That was the headline grabber for many. If you set up a new manufacturing unit after October 1st, 2019, and got it running by March 31st, 2023.
You qualified for that super low rate.
Exactly. Just 15% base rate, or 17.16% all in. Yep. Really competitive.
So what were the stated goals? Why make such dramatic cuts?
Well, the government laid out several objectives. They wanted to simplify the tax system, make it significantly easier to do business in India.
Attract more foreign investment, I assume? FDI?
Definitely. Boost domestic industries, too. Encourage greater tax compliance, and the big one, ultimately, spur broad-based economic growth.
Now, those kinds of deep cuts, they obviously come with a price tag.
Always.
What was the estimated cost to the government?
The estimate was around 1.45 lakh crore annually, which is quite a sum, about 0.7% of India's GDP in fiscal year 2020.
That's significant, and the changes didn't stop there, right?
Yeah.
Fast forward to 2024.
Correct. The government took another step then, removing the controversial angel tax rules.
Ah, yes, the tax on capital raised by startups.
Exactly. Many startups argued it stifled early-stage investment, so removing it was seen as a clear signal of support for, India's growing innovation ecosystem.
And how did all this fit into the global picture? Were other countries doing similar things?
It's important to see in that context, yeah. India wasn't alone. There was, and still is, a kind of worldwide trend of decreasing corporate tax rates.
So these reforms helped India catch up or even get ahead?
Pretty much. The new rates made India's corporate taxes lower than places like Brazil, which is around 34%, and Germany at 30%. They became comparable to major economies like China and Korea, both around 25%. And that incredibly low 17.16% rate for new manufacturing, that actually matched Singapore's rate. It really positioned India as potentially a very attractive place for new industrial investment.
Okay, so ambitious goals, dramatic changes, a huge price tag. The core question has to be, did it actually work as intended?
The million-dollar question indeed.
The initial hope was for this investment-led economic revival. What did the early signs suggest? Was it a smooth takeoff?
Well, initially the picture was, let's say, mixed. Some early reports actually painted a bit of a concerning reality.
Oh, so?
An RBI annual report, this was August 2020, stated quite directly that the corporate tax cut did not help in restarting the investment cycle as was intended.
Really? So what were companies doing with the savings, according to the RBI?
The report found they predominantly used the money for things like servicing debt, building up their cash balances, other current assets.
So basically not immediately plowing it back into new factories or big expansion projects.
That's what that early RBI analysis suggested, yeah.
And did other broader economic indicators reflect that?
We did see some key investment indicators decline around that time. Gross fixed capital formation, which is basically a measure of investment in physical assets.
Right.
That dropped from nearly 32% of GDP in 2018-19 down to under 30% in 2019-20. Capital goods production, imports, they also contracted.
Any other sources back that up?
CRISIL, the rating agency, echoed this in a 2023 report. They noted that while, sure, companies' profits improved after the cut.
Which you'd expect.
Right. But they didn't seem to significantly increase their spending on new capital projects.
Okay, so that initial picture seems a bit disappointing compared to the hopes.
Yeah.
But you mentioned the story gets more complex.
Yes, and this is where it gets really interesting and why looking at multiple sources is so vital. While those early reports suggested companies just sort of pocketed the savings, a deep dive by the National Institute of Public Finance and Policy, NIPFP, found something quite different.
Okay, what did they find?
Their study actually uncovered a significant increase in investments, specifically among domestic manufacturing firms after the tax cut.
Wow. Okay, that directly contradicts the earlier take. How do we reconcile that?
It's a great question. It likely comes down to methodology and focus. The NIPFP study used direct firm-level data looking specifically at manufacturing.
And what was their key finding?
They found the positive effect on investment was stronger for larger domestic firms. These bigger companies saw a pretty substantial 6.7% increase in investment.
6.7%. What did that mean in real terms?
It translates to about 138 million or roughly $1.6 million per firm in 2020. Not insignificant.
In smaller firms.
They also increased investment by a notable 3.1%, so still positive, just less pronounced.
And why did NIPFP think this happened? What was driving that investment?
They pointed to two main things. First, lower tax rates reduce the required rate of return on a project, making more investments look attractive. Second, it simply increases the cash firms have available to invest.
So the NIPFP view suggests that, at least for manufacturers, particularly larger ones, the tax cut did spur investment.
That's what their evidence indicates, yes. So the picture on investment is definitely more nuanced than those initial reports might have suggested.
Okay, that's clearer. Let's shift gears slightly. What about the broader impact on India's GDP and, critically, the government's overall tax revenue? Did those big cuts end up hurting the Treasury long term?
That's another fascinating part of the story. An empirical analysis, this one published on Zenodo, found an incredibly strong positive correlation between India's GDP and its corporate tax revenue.
How strong?
Like a correlation coefficient of about 0.98, super high. It basically means almost 96% of the variation in corporate tax collections can be explained by changes in GDP.
So a healthy economy means healthy corporate tax revenue,
Yeah.
even with lower rates.
That's the implication. It suggests a very responsive relationship. As the economy grows, corporate profits grow, and even at a lower rate, the tax take increases.
Okay, but there must have been an initial hit to revenue right after the cuts, especially with COVID hitting soon after.
Oh, absolutely. There was an initial drop. Fiscal year 2020-21, which was heavily impacted by the pandemic, saw corporate tax revenue decline by nearly 10%.
Right, but did it recover? Did the government manage to make up for that lost revenue?
They absolutely did, and remarkably strongly. Overall, direct tax collections, which includes corporate and personal income tax, rebounded incredibly well in the following years.
What kind of numbers are we talking about?
Huge growth, nearly 50% increase in FY 2021-22, then robust growth, around 18%, in both FY 22-23 and FY 23-24, and even the provisional figures for this fiscal year, 24-25, show growth over 13%.
Wow, so the tax-based buoyancy was strong.
Very strong. In fact, the direct tax to GDP ratio actually hit an all-time high of 6.11% by 2024. Part of that is recovery, but it's also credited to increased compliance and better digital monitoring systems.
So the cuts didn't permanently damage revenue streams, it seems? Were there other positive outcomes beyond just the financial numbers? Signs of broader economic impact?
Yes, definitely. The specific incentives seem to work quite well. For example, that Section 115 BAB, the one offering the super low rate from new manufacturing.
Yeah.
The number of companies claiming that benefit surged. It went from under 3,000 in assessment year 2022-23 to over 7,000 in AY 2024-25.
That's a big jump. Suggests it really encouraged new units.
It does, and similarly, startups claiming deductions under Section 80 IAC. That also grew significantly, from around 300 to nearly 900 in the same period.
What about jobs? Any link there?
There's an indicator for that, too. Section 80 JAA gives deductions for employing new workers. The number of companies claiming that increased as well. All these specific initiatives are generally credited with, fostering new business activity and generating employment.
Okay, so we've seen clear positives.
Yeah.
A rebound in revenue, targeted incentives hitting their mark, signs of increased investment, at least in manufacturing. But like any major policy shift, there are usually unintended consequences or ongoing challenges.
Always two sides to the coin.
What's one of the less obvious but maybe significant concerns that has emerged from this?
Well, something fascinating and a key fiscal concern is the trend in revenue foregone.
Revenue foregone. Explain that.
It's basically the amount of tax revenue the government doesn't collect because it offers various exemptions, deductions, and incentives. Think of it as the cost of tax breaks.
Okay, and what's the concern there?
The concern is how much it increased. It saw this massive jump, over 800% between 2020 and 2021, and the estimate for 2024 is around 1,015,000 crore.
Wow, 1.15 lakh crore? That's huge.
It is, and it raises serious questions about whether these broad blanket concessions are sustainable or even the most effective way to encourage growth in the long run. Many analysts now recommend moving towards more targeted tax benefits, maybe linked to performance.
That makes sense. A more targeted approach.
Yeah.
And how did these big corporate tax cuts affect the overall tax mix? Did the burden shift onto others?
Yes, that's another major outcome. The 2019 cut fundamentally altered the composition of the central government's gross tax revenue.
So,
Corporate taxes share just fell significantly. It used to average around, say, 34% of total tax revenue in the years before the reforms.
and after?
It dropped to just under 26% in the following fiscal years, up to FY25.
So who picked up the slack?
This is what's really notable. For the first time in recent history, collections from personal income tax and the goods and services tax, GST, have actually overtaken corporate tax collections in multiple recent fiscal years, FY21, FY23, FY24, and likely FY25 too.
That's a massive shift. So individuals and consumption are now contributing a larger slice of the pie than corporations.
Relatively speaking, yes, it marks a significant structural change in how India's tax system is funded.
Interesting. Okay, what about the impact on, the average person? Wages, jobs. Did the benefits of these corporate cuts trickle down effectively?
That's a critical question, and the analysis here is, well, quite sobering. While overall unemployment did decrease post-pandemic.
Which is good.
Yes, but much of the new employment created seems to be in more insecure forms of work. Think gig workers, short-term contracts.
Okay. What about regular, stable jobs?
The share of regular wage employment in India actually fell. It went from about 23% in 2017-18 down to just under 21% in 2022-23.
So fewer people in stable, salaried positions, relatively speaking.
Correct. And if you look internationally, like the U.S. experience with their big corporate tax cuts,
Yeah.
studies there showed only a very modest impact on wages, less than $1,000 per worker on average. It highlights that corporate tax cuts don't automatically or significantly translate into higher paychecks for most workers.
So the quality of employment and broad wage growth seem to remain persistent challenges, even with these reforms.
That appears to be the case, yes.
And looking at the tax base itself, are more people actually paying income tax now? Or is the burden still falling on a relatively small group?
That's another ongoing challenge, unfortunately. Despite all the reforms, a huge chunk of people who file income tax returns on average, over 65% between FY20 and FY25, declared no taxable income.
65%. So they file but don't owe anything.
Exactly. Which means the number of actual income taxpayers as a percentage of the whole population remains quite low. It even dipped after the reforms initially before climbing back to only about 2% by FY25.
Only 2% of the population paying income tax.
Effectively, yes. So while direct tax collections have rebounded strongly, thanks to higher profits and better compliance from those who do pay, the overall government tax take as a share of GDP hasn't dramatically increased. It's remained sort of range-bound at 10-12%. The base hasn't fundamentally broadened yet.
And one final point that often comes up with tax changes policy stability. Have these frequent adjustments been flagged as a potential issue?
They have. Experts do point out that frequent changes in tax policies can create uncertainty, which might make investors hesitant.
Makes sense. Businesses like predictability.
Exactly. There's a general feeling that consistency and stability in the tax regime are really crucial for building long-term confidence and encouraging sustained investment.
Okay, so let's try to pull this all together. What does this deep dive tell us? India's corporate tax reforms. It's clearly a complex story, isn't it? Lots of interconnected chapters.
Much so.
We've definitely seen clear evidence of positives. Increased tax compliance seems real. The rise in new manufacturing companies taking advantage of those low rates is notable.
And that strong, healthy link between GDP growth and rebounding tax revenue is also a key positive takeaway. The system showed resilience.
Absolutely. But on the other side of the ledger, as you said, we've uncovered these ongoing challenges.
Right, that rapidly increasing revenue foregone from all the incentives, that's a big fiscal question mark.
And the significant shifts in the overall tax burden, with personal income tax and GST now playing a larger role compared to corporate tax.
Yeah, and those lingering questions about how broadly these cuts really translate into investment across all sectors, not just manufacturing, and maybe most critically, into improved wage growth and higher quality employment for the average worker.
So it's clearly not a simple yes or no answer to whether it worked. It's much more a nuanced picture of an economy in dynamic flux.
That sums it up well. A major experiment with mixed and still evolving results.
Thinking about this complex journey then, this inherent tension between, say, attracting investment with lower taxes and, on the other hand, ensuring fiscal sustainability and making sure growth is equitable, that it benefits all parts of society.